15 years down the line, it's not very easy for you to figure out what is the pace of adoption going to be. I mean, some of the things that really spooked the market this time around is that even if you look at the monthly transacting users, right, forget about what they're spending, that growth has completely plateaued. It was true for Zomato, it was true for Nykaa. And, that brings us to what we all talk about, that, we have got two Indias. There is an urban market, which means that you got about 15-20 million households which are essentially spending. And therefore, to try and extrapolate the heady growth rates of the last 2-3 years into 2035, to me, doesn't make any economic sense.
Nirav, hi, afternoon. With we'll never know. I mean, if this is it, and whether there is another large leg down. But what does make sense to you? What kind of names would you venture into? Commodities, where I mean, some of the stuff at the margin has only helped boost prices even higher. I'm not just talking about oil, but even base metals. Take a look at aluminum. Take a look at copper. Would you look at something else? Where do you think there is already opportunity emerging?
Well, let's look at the big pillars of the market, right? Banks, that is close to about 35% of the Nifty. And look at the earnings delivery and put that in the context of the valuations. Also, I think one of the reasons that we believe that if you look at now the plethora of all the companies, they have virtually stopped taking risk. Almost all the banks are talking about 90% of the incremental disbursements happening to A and above, which means that you're likely to have a below average credit cost for a long time into the future, right? You still don't have that confidence to try and start writing big checks to corporates, start taking and building some more risk. And you just got credit, which is now sort of taking off from 5, 6, 7 year lows that you've seen over the last several years. So we like that pocket very much. We also like domestic cyclicals, and so that is going to be the big thing, essentially. Manufacturing capex coming back, investment cycle. We are not going to see too much of a delta in terms of the government spending because of the stretch finances. But those sectors will play out well, and then obviously you've got all these ancillary activities that come around it, which is the building materials and tiles, and real estate seems to be doing well. I'm fairly constructive on the markets. I'm not too bearish.
Okay, all right, Nirav, what about IT? That did very well in 2021, and I want to ask you about particularly large cap IT. TCS has outperformed. It had the support of buyback. Now that's out of the way. We're seeing TCS see a bit of a correction. Infosys is still 10% away from its 52-week high. What's the toss-up between them? Your view on large cap IT, and what would you pick from there?
So I think some of the work that we have done, broadly, if you now look at IT over the last 2 years, the P's have essentially gone from about 18 times forward to, they peaked out at about 32 times. They are back to about some 24, 25 times. This entire re-rating has been driven by an uplift in earnings growth rate. So the CAGR till about FY20 was about 8 or 9% in earnings, and that CAGR has gone to about 15 or 16%. Right now, as far as the visibility is concerned for FY23 and to some extent in FY24, we believe that we are likely to see about double-digit growth rate in earnings. Obviously, there's a section of the market which believes that because of the big reset that you got in bond yields, and therefore, Fed will continue to hike the rates till it reins in the economic growth rate in US, and therefore the impact on IT. I think if at all that will be an late FY24, FY25 story. Today, as things stand now, I think large cap ITs are a better bet, especially as compared even to mid cap ITs. So we like this space.
Okay, fair enough. What about the metals, Nirav? Because one thought it was a big super cycle. We had huge rally in names like Tata Steel, but the correction from the highs has been quite sharp.
Yeah, so I think that you don't have to be very bullish on prices to buy a lot of these metal stocks right now, right? So if you look at the current delivery of the earnings and the current enterprise values for a lot many stocks, it makes decent economic sense. Also, we need to appreciate that a lot of these companies have got far better capital allocation policies as you move forward, right? So their ROE evaluation, ROC evaluations will be significantly better. And I also believe that they are significantly underwhelmed. I mean, people just hate buying PSU stocks. ONGC is trading at some 2.5 times EV to EBITDA. Coal India trades at about 8 or 9% dividend yield, stocks like that. And I believe that as you move forward, I'm not saying that these stocks are going to get re-rated as in re-rated, but I believe that there is a case that there will be a significant outperformance for a lot many of these stocks. And in a sense, we're seeing this, right? So it is ICICI and now Axis stocks which have been outperforming HDFC banks and the Kotak Bank. Barring, I think, Pidilite and Asian Paint, almost all the consumer companies, all these companies trading at 55, 65 Ps, they have started underperforming significantly. I think this is a part of a bigger trend. So as the economy grows, as the earning growth picks up for a larger part for the broader market, you will see a lot of reallocation that happens across the investor portfolio as well.
Nirav, I mean, so you mentioned banking earlier. I'm not saying that that just because people own it, it can't do well. But it's almost a universal. You call up anyone, talk to anybody. I mean, it's basically the number one theme. What will do well this year? Banks. And it's not just private, but there are enough fans for public sector banks as well. Again, not to be sort of taken against them potentially performing well, but is that a bit of a challenge over ownership?
No, so I think that do you want to take a contrarian call just because you want to be the other side of the table? My answer is no, right? So I'm still essentially trying to focus on the earnings. I'm trying to look at the prospects of the banks in the current cycle. We are off. I mean, just think of it. Even we are talking about super growth in terms of economy sort of coming back after a long time. And you had 6 years of below nominal growth rate in credit, right? And that is unsustainable. I think that credit is the biggest leading indicator of an economic growth rate. So that is number one. Secondly, I think that there is a big mindset change in the way the banks are being run, right? And that is largely because investors have rewarded banks like Kotak and HDFC Bank. And obviously, this tends to have a ripple effect on everyone around. So I think that banks are getting smarter and smarter in terms of underwriting going forward.
Right.
So you will have a great bull market when everyone converges to an idea, right? So that is one way of looking at it. So I agree that probably having a positive view, it's a consensus view. But that consensus view has to play out. And I believe that
absolutely
that's going to be the case going forward.
Absolutely, Nirav. We get that point, and we thank you for stopping by and giving us your view on a whole host of sectors. You're not a big fan of those high PE stocks, the new age stocks, some of them that are making losses, but you believe that the manufacturing sector here in India is up and kicking as well. By the way, keep an eye out on the index. The Nifty Bank came within 40 points of moving into the green. And just take a look at what's happened in the last few minutes. Don't pull up the Nifty, pull up the Nifty Bank actually. The Nifty Bank is now down